Welcome back to Mark Carney's book club. This is part 2 of chapter 15, Investing for Values, and we're just discussing fiduciary duty, which has come up in reference to Mark Carney. I have brought up the fiduciary duty that he had to Brookfield or any corporation that he was working for as a finance professional. He had a duty to work in their best interest. And as long as he wasn't breaking the law, which tax avoidance unfortunately is not breaking the law, he was just doing his job. He's claiming that the fiduciary duty held needs to account for the interests of beneficiaries beyond just financial considerations. So just as beneficiaries can specify their risk appetites, they could also specify the degree by which they wish to prioritize non-financial values. Governments have a role in clarifying the scope of the duties of investors and encouraging clear communication with beneficiaries. This is becoming more systematic. New EU rules require financial market participants to consider sustainability risks in assessing financial performance and to publish how they integrate these considerations into their decision-making. The new rules clarify how investment managers should conceive of their fiduciary duty to their clients, mandating a focus on long-term and sustainable value creation. The U.S. conception of fiduciary duty has evolved rapidly in recent years. During the Trump administration, the Department of Labor stated that it is unlawful for a pension plan fiduciary to sacrifice return or accept additional risk to promote a public policy, political, or any other non-pecuniary goal. Under rules adopted in 2020, plan sponsors could only consider pecuniary or performance-related factors when selecting investments. Private pension administrators were expected to prove that they were not sacrificing financial returns by investing in ESG-focused investments. Given the growing track record of ESG in creating shareholder value, it is perhaps no surprise that the vast majority, 95%, of responses to the Department of Labor consultation were opposed. The Biden administration has changed tack entirely. It adopted a non-enforcement of the 2020 final rule and then issued an executive order that asked the Secretary of the Department of Labor to identify what actions the Department of Labor can take to protect the life savings and pensions of United States workers and families from the threats of climate-related financial risk. And I'm sure that's all been undone, but this took place before the second Trump administration began. He says that there's still work to be done in most jurisdictions to move laws towards ensuring investment managers must understand the sustainability preferences of their clients, as well as the impact of ESG factors on long-term value and risks. In the meantime, investors must work within the parameters of their legal duty. The investing ecosystem is complex and rapidly evolving. He's next going to clarify the actors involved, the information they need, and the actions that they take. Companies which receive the investments and put that money to work to create economic value and social impacts. The latter can be deliberate or unwitting, positive or negative. Investors who provide capital to companies to support their activities. As we have seen, they can pursue strategies ranging from traditional investing that does not take into account ESG factors to integrated and impact strategies that systematically do. Other stakeholders, which include the employees, suppliers, customers, and communities that are affected by the actions of both companies and investors. And governments and regulators, which oversee the system, set the rules and are responsible for addressing the systemic consequences of the actions of the companies and investors. All of the actors mentioned there want to assess both the economic and social impact of companies, and some information comes directly from the companies while other information comes from third parties. So once the information is disclosed, the question becomes what to do with it. Some investors do their own analysis to assess a company's impact, while others rely on third-party ESG ratings providers. Further on information and disclosure. So the information set for stakeholder value creation has 3 elements. So the first is traditional financial reporting, which as a practice is relatively mature and has a robust governance structure rooted in the private sector and overseen by public authorities. The second is sustainability reporting, which is new and rapidly evolving. As demanded by both investors and society, many publicly traded companies now produce some form of sustainability reports and wealth of public information from social media to scientific analysis, which informs the current state of sustainability and public expectations for its evolution. These broader considerations mean that what companies need to report is broader than just those sustainability factors that drive economic value. And it underscores that they should be mindful of how the requirements of social license may evolve. No company is an island. For example, before the carbon budget had been set, issues of environmental sustainability were principally concerns for energy companies and very heavy polluters. Now that the carbon budget is on the verge of being exhausted, environmental sustainability is an issue for everyone. After a period of innovation in sustainability reporting, it is now time to consolidate and rationalize the various standards. So there are 3 types of efforts here: private, standard setters, and public sector. So he does bring up the WEF. So let's see what he has to say about this organization that the right has decided to make the boogeyman, despite having been members themselves just a few years ago. First major effort to consolidate sustainability reporting was launched by the International Business Council of the World Economic Forum. This collection of 140 leaders of the world's largest companies have worked with the big four accounting firms to develop a framework for corporate reporting and a minimum set of common metrics and disclosures tied to the UN's SDGs and covering the topics of people, planet, prosperity, and principles of governance. The agreed standards are drawn wherever possible from existing standards and disclosures. So then he mentions efforts by the Impact Management Project, or IMP, who aim to create a consolidated global sustainability reporting architecture that integrates reporting. The IMP framework accommodates different layers of materiality, covering what is already reflected in financial accounts, and information material for enterprise value creation, and information material for sustainable development. He's now going to discuss the three main approaches to applying ESG factors. The first is ratings-based, so where assessments of ESG performance are outsourced to a third-party provider. There's a large number of ESG ratings and data providers offering a wide array of data. These range from specialized providers that calculate metrics on specific ESG components, such as scores on carbon and gender diversity, to providers that rate companies based on hundreds of ESG-related metrics. In early 2020, around 70 different firms provided some sort of ESG ratings data. So ESG ratings data can be inconsistent since a lot of it is self-reported by the companies, and different ESG data providers may use different methodologies to come up with their results. This highlights the subjective nature of many of the judgments of ESG ratings providers. So a second approach to apply ESG factors is fundamental value. So raw ESG data is analyzed as part of an integrated assessment of the relationship between the creation of sustainable enterprise value. Data is collected from publicly available information, and we're out of time, so we're going to have to finish this up in part 3. Stick around.